Now, Brett is going to talk about something that is on everybody's mind. Unless you guys, again, did I cut you off? Do you want to more? Do you picks and shovels, Brennan? Do you got any picks and shovels info?
Brett can go, or no, I don't. But
You
yeah,
got nothing.
we can go on to
All
Brett.
right. It's what's on everybody's mind. Is steel a steal?
You love that one, don't you?
I've been saying that for years. Yeah.
Yeah. So as we know, Trump has just been constantly shifting tariff levels forward and back. You have the Trump always chickens out the talker, which the reporter brought up to him. And so, of course, now this last week on Friday after market close, we had another tariff announcement, and this time it is increasing the tariffs on steel and aluminum to 50%. Prior in March, he had it set at 25% from the previous 0%. And this new tariff, the 50%, it will be effective June 4th, assuming nothing changes. I always have to, whenever I'm doing these segments now, I have to say, assuming nothing changes, because it always seems to. And I will remind our audience as well that in Trump's first term, he actually did apply tariffs on steel and aluminum, which lasted about a year. So it might not be, we might not have them for 5 years, we could have them a year, or they could be gone by the end of the week. We will just have to wait and see, or they could last for years and years to come. So now on to the market reaction. On Monday, as where we are recording this, U.S. hot rolled coil steel futures had jumped over 15%, and aluminum Midwest U.S. premium is up 41%. I will note as well there was a month rollover for the futures, which does impact the price, but the majority of this change will just be purely due to tariffs. So really big, effectively day-over-day increases of price of both the commodities or commodity products due to the tariffs. So, and then we can see the same reaction in the stock market as well. Cleveland Cliffs, CLF on the New York Stock Exchange rose over 20% on Monday. I think before market, it was actually up 35%. So massive increase overnight. But that is actually still down 20% over the past month. And it is one of the biggest winners actually on this policy shift. As the stock market reacts, it was one of the biggest increases, if not the biggest increase. Probably depends on the time of day you have looked and where it actually closes at. Another big mover, Century Aluminum Company, CNX on the NASDAQ, up 18% on the day, and it's up about 6% on the month. On the other hand, if we look on the other side of the border, really more than anything, we see the negative movement. Algoma Steel on the TSX, and they as well trade on the New York Stock Exchange. A Canadian producer is down nearly 7% on the day, but it is as well down 15% on the month. Historically, 60% of Algoma's production was US bound, but under the current pricing and tariffs, it would just be difficult to see Algoma being competitive in the market. So likely that's going to drop to very low amounts in the coming months, assuming nothing changes. Further, as other producers aren't shipping into the US, as the entire market will react to not just Canadian, but any other participant that was shipping into the US, steel price might get either diverted into Canada, or within the Canadian market, it stays within Canada for a Canadian producer. So you'll see steel prices actually decline as well as aluminum prices within Canada, putting further pressure on Canadian producers. So we'll see how that ends up. So does this policy of protectionism on U.S. steel and aluminum make U.S. steel producers an appealing investment in steel and aluminum producers? As the price of steel and aluminum rises, producers benefit. That's pretty straightforward to see. If prices do continue to rise, however, you will end up getting non-U.S. supply coming back into the market, even with tariffs, if you see a massive regional price discrepancy, as there will be substantially different prices between the American prices and effectively everywhere else in the world, a regional price discrepancy. And likely if the tariffs last, countries will actually have retaliatory tariffs against the U.S. and steel and aluminum industry, making U.S. products actually less competitive on the global stage. So we'll see how that dynamic works out, both external to the U.S. and internal to the U.S. So the U.S. is a net importer of steel and aluminum, so they import more than they export. U.S. net imports are 13% of consumption for steel and 47% for aluminum. So aluminum is much more dependent on non-U.S. production. In 2018, Trump's first term, tariffs actually had only a 10% tariff on aluminum versus 25% on steel. So you can see even then, pulling back a bit more on aluminum compared to steel. So if anywhere, I could see pullbacks on aluminum occurring before steel or negotiating, something like that, as that is a more critical aspect for the US economy to actually import steel at this time because they just don't have the production level and they have higher demand in respect to the production level. So, as we've seen before with tariffs in general, policy reversal will now be really a massive risk for companies that have seen a jump in price. This is Cleveland-Cliffs, for example. The company has not been profitable in Q1. The company had revenue of $4.6 billion and an adjusted EBITDA loss of $174 million, which that would include the first 25% tariff for the 1 month, so March effectively, and it still wasn't profitable during that quarter. But most of the quarter wasn't really, it had no tariffs, but there was an increased price during steel during the quarter. So there was actually a positive impact and they still weren't profitable. The point here being, while tariffs may be beneficial to the company, it does not necessarily create this massive gold rush moment, at least at this time. Just a better environment. It is no different really for the US producers compared to other periods of hiding prices. Like during COVID, you saw massive price increase then. I think it was about twice the price it is currently now, even after the tariff price changes. And they did have what I would call a gold rush for steel at the time, or steel rush if you want to. The company as well does have a significant debt level, which I will just highlight as a general. So periods of weakness are especially harsh due to the interest rate burden. So with these fluctuating steel prices, if they are actually lowering their capex for the year, but let's say tariffs last year, they start to ramp up their capex. Just using another example, because then if you have the tariff removals, that can get them into trouble with the debt level. You always want to look at the company as well as just the industry macro, and that's what I want to get to the point with this. As well, the other point, which is the point which I really chose out Cleveland-Cliffs, is because the company actually did acquire Stelco, a Canadian-based producer, as a publicly traded one as well, just last year. So tariffs have caused the company subsidiary Stelco to actually focus 100% of its Canadian production to 100% Canadian sales. So you can see there on the map, they previously had about 30% going into the US. And that's what I mean. Canadian manufacturers of steel and aluminum products are probably going to keep them in Canada now, which will drive prices down here while the US prices actually increase. You're going to see this regional dynamic, which is actually going to be quite interesting to see how it plays out. And it's just going to overall increase the competition within Canada. As well, I will mention, though, that it is a bit of a drawback for Cleveland-Cliffs. So it's not even just this black and white, even for an American company. The one that really, on the first day of the stock market, saw as the biggest benefit, they were up 20% at time recording. It does even have a bit of gray for them because they are obviously going to have a bit of a pullback on their Canadian side due to this. And it's something they just acquired last year, which obviously not great timing for them on that. And I just want to wrap this up, I'll just simply state, do not invest in a company due to a policy. Invest in a company that can be great no matter the environment. As I was showing, Cleveland-Cliffs, it's losing money right now. Tariff environment might make it better. It probably will for the company as it is primarily a US producer. But that does not make it a great company. It does not make it a great investment over 5-10 years like you really want to be. It could be a trade, but we are not traders. We are investors. We're looking at the long term, and a policy does not make an investment, especially something which we have seen. Even in his last term, lasted a year, it was repealed. And you've obviously seen other pushback on tariffs in the US economy as well. And as well, just for disclosure, we don't have any investment relationship with the company. Cleveland-Cliffs, that is. So I don't know if you guys have any comments or anything.
Yeah, I'd just say it is interesting, just, what we're going to see, the regional differences in the pricing, but from Canada versus the US. And yeah, it's definitely something that we'll monitor. But, even when we were, looking at this segment beforehand, Brett was asking, is there, a pure Canadian steel index? And, I'm not sure of one. But, it'd be great to actually see that.
Yeah, we do get some lagging price, but no futures or anything, and I didn't think there was any as well. Mm-hmm. But yeah, no, Ryan, sorry.
No, I mean, it will be interesting to see the price differences between Canada and the U.S. These companies are historically, almost hysterically too, but volatile in their pricing and in the share prices in the sector. You can have, boom bust demand cycles. 1 year, a company is extremely profitable. The next year, it can literally lose money. They're very difficult to value on a cash flow basis. Like you have to do a normalized type cash flow. You have to look historically and then look at where their production is coming online. I mean, it is a segment that we'd like to see a really good balance sheet in these businesses because of the volatility. And often there's tons of CapEx. So you have balance sheets that don't look the greatest, but in good and bad times, these companies are very hard to be a long-term investor in unless you're comfortable with the fluctuations in cash flow on a quarterly, year-over-year basis, and or you're looking long term and predicting the business. I mean, like a smaller company that gets built out to get bought in that sector, if it's done well, potentially can be a story. And I mean, Stelco did that essentially over time and was fairly well run, but there's such a high degree of volatility. It's hard to fit our model.